And a very good afternoon to you, and welcome to the Horowitz Company Pop-Up Q&A webinar. It is now August 24th, 2020. And again, I really appreciate everybody joining along each and every week as we've been doing this for the last, what is it now, 5 months or so? Seems like it was just yesterday when we were all really looking for some answers of what was going on with this entirety of the lockdowns and the potential for this pandemic. At the time, it wasn't even considered a pandemic, if you recall that correctly, and markets were just in absolute free fall. And we decided, you know what, we're going to do something to try to understand together what's happening with the economy and the markets, the interrelationships, as well as answer any questions that you have. And I think we've been doing a pretty good job of it by the size of the audience that gets together each and every Monday. So a couple things I want to mention to you. First of all, these are recorded and they are available for replay pretty much the day after that we do this on thedisciplinedinvestor.com. Just look on the right-hand side and you'll see where that recording is, and you can play it. And if you miss something or you kind of want to just do a little refresher of it, it's there. So please utilize that. Secondly, I want to mention that, of course, anything we talk about here is not necessarily a recommendation at all to buy or sell any security, and past performance is not indicative of future results, as well as the fact that it is for educational purposes only, and we're not giving investment advice in this particular discussion. Of course, that is specifically for our clients, for the clients of either any of the strategies, actually, Investology, the managed growth strategy, or our global allocations. The other thing to mention is, of course, this is for you. What we do here is we have this open forum for discussion where you can ask any questions that you have regarding any topic at all, and we'll do our best to address that and to answer that. So if you want, you could start asking questions. We'll do a little bit of a preview and a review of what's gone on, and then we'll get into the questions. The questions that you ask can be done through the application that you're looking at, which is Zoom. There's a Q&A panel on the bottom. Now, before we get started, I've asked this before, and I want to get a bit of a pulse of what is you're thinking right now. A little bit of we'll take the temperature of the room, so to speak. So a poll that just recently launched right there on your screen. And the question is, now, today, how do you feel about your current portfolio holdings? Are you not worried? Are you concerned? Are you scared? Or, well, I'm just never comfortable no matter what happens, which, a lot of people have that situation where, if it goes up, I'm worried it's going to come down. If it goes down, I'm worried it's not going to come up. And this is actually a problem. I'll share this with you because I've, over the last several weeks, I've gotten some calls from people, and we discussed the idea of, what to do, where are the markets going, what's going to happen. A lot of confusion for people still about the election, of course, and the issues related to the potential for further lockdowns, or even for just a stagnating economy long term, and how are these companies going to make any money, and what's going to happen to my stocks. And one of the things that happened was that we talked about the idea of one person in particular. He's not a client, but he said, "Listen, Andrew, I've talked to a few advisors, I've talked to people, and they've said to me, when I ask the question, what should I do now? Because I want to," this is what he said, "I want to get out of the market. I feel it's too high. I feel that, one day I'll get back in, but it doesn't make any sense to me, and it's keeping me up at night. And while I've had a good run, I held in there through the March lows. Everybody is just telling me, don't do a thing. Andrew, what do you think?" And I said, "Listen, I don't know your portfolio, to be honest with you. I don't know what your situation is, but I can tell you this, that if in fact you are nervous and scared, and you're to a point where you're not sleeping at night, and where you're reaching out to me, a longtime friend, someone I've known for a very, very long time, and you've already spoken to your investment advisor, and you've spoken to 2 or 3 others, and this person's a doctor, and what you're doing is coming to me for a second opinion, a third opinion, a fourth opinion. It's kind of like the person that goes to the doctor," I told him, "and the doctor says to the patient, 'You need surgery.' And the patient says, 'I'm getting another opinion.' He goes to the next doctor and he says, 'I think you need surgery.' And he says, 'You know what? I'm going for a third opinion.' Goes to another doctor, and the doctor says, 'You need surgery.' He says, fine, I'm going one more. I'm just going to one more doctor. And the doctor says, you know what? You don't need surgery. And the guy says, aha, I knew it. So that's the kind of situation where he's looking for me to confirm that maybe he should be out of the market. And I said to him this, I said very, very clearly, if you want to move out of the market for whatever the reason is, and you feel that, you're just not able to deal with it right now, there's nothing wrong with that. But there are other ways to do it. If in fact, though, you still want to actually move out and you want to sell all of your assets, do not do it unless you have a plan long-term to get back in somehow, some way. Because what's going to end up happening is either one of a few things. The market over the next year or two doesn't go anywhere. Or the market moves up and you think, you know what, I'm not getting in because it's even higher than when I got out. There's no way it's going to sustain this. Or it's going to go down, and when it goes down, you're going to say, you know what, I knew it was going to go down, and I think it's going to go down a lot lower, and I'm not putting my money to work in that kind of situation. So in other words, looking for that confirmation from an investment standpoint, just like that patient looked for confirmation for a doctor who said, you don't need surgery, I am not going to tell you necessarily to get out of the market because I don't know your situation. But if you do, after all your research and all these discussions, decide to get out of the market, have a plan that you stick to in order that one day you invest yourself again. Whether it means that the markets come down, this is what I'm going to do. Whether it means if the markets don't go anywhere for a period of time, this is what I'm going to do. Or if the markets continue higher and you miss out on some of it, okay, but what are you going to do? Because if you don't do that, you're going to end up in a whole heap of trouble. And I've seen it before, people that are just looking for the markets to come down to satisfy that they are right and therefore miss out. I could tell you tons of stories of this. Over the last number of months, I had prospective clients call me and said, you know what, I'm out of the market and I just think it's too high. And I kick myself that I didn't get back in, but I'm not going in now. I said, if you're not going in now, which let's say this was back in May, when are you going to eventually go back in? What's going to be the cue? What's going to be the answer? And if the answer is, well, if we come down again, 10% or 15%, then I'm going to buy in. But meanwhile, the stock market moved up 10 or 15%. So you're going to have to wait for that correction, which is no different than where you are now. Not, again, that is necessarily the case that you need to be invested fully or you need to be fully involved in stocks. But again, folks, the point here is this. The point here is the process, the discipline, the idea that you're investing for your long term. This is not a 1 day or 2 day discussion. We're not talking day trading. We're not talking swing trading. That's an entirely different environment, and there's a place for that, no question. And you can definitely utilize that for diversification and for style adjustment and all of that. But if you're investing for your long haul, you have to be careful. This idea of totally in or totally out doesn't make a lot of sense because a lot of other options you have along the way. All right, for those of you, there's a couple more people that entered. If you want to do the poll really quickly, how do you feel about your current portfolio holdings? I will then get to that in about 30 seconds. So where are we right now? We like to do this little recap of the market. Seasonally at this point, it's pretty much the slow part of the year, kind of the summer slog, where we have lower volumes. Traditionally, people are on vacation, right? The old notion that traders have left for the Hamptons is really not as much in play this year as it has in the past. But daily volumes have been coming down since July. So we are still in that seasonal period where there's, a slower market environment, which is really interesting due to the fact that we've seen while volume is coming down, markets don't seem to be too worried about that, nor can the sellers can get any footing in the selling process. A little bit here, a little bit there, a little bit of rotation. But generally speaking, once we saw that Apple, which I believe tomorrow is the split date, announced their split and took off, the largest company now over $2 trillion in market cap, a very heavily weighted position in the market took off. It took the rest of the market with it. So Not much has changed for the complexion of the markets recently. We have very narrow breadth, which means the advancers and decliners, which stocks are making headway and which aren't. In fact, the breadth, the advanced decliners have really narrowed out in the past couple of weeks significantly. And at the same time, we've seen this divergence in performance, right? Even though the advanced decline line has been coming negative, we see the advancement in the markets going positive, and that's due to the mega caps that are leading. We talked about this in detail, and I have a chart to show you in a second. I talked about this on the Disciplined Investor podcast this week. Make sure to listen to that. We had a great guest from TradingView. We have some great guests coming up. We also had, over the past 3 or 4 weeks, some of the best guests we've had in a while. So definitely make sure to listen to that and subscribe to it on iTunes or wherever else you get it from, because it was really some, I think, enlightening information that was brought to us by our guests. So these mega caps that are leading are pretty much doing all the work to pull the indices higher right now. All right, with that, let me take a breath. Let's end our polling, and let's tell you the results. So the question was, how do you feel about the current portfolio holdings, your current portfolio holdings? The winner, 50% not worried, 29% concerned, 3% scared, and 18% said they're never comfortable. Now, I think there's a bit of a flip-flop here from when we did this probably over the last several weeks, where we had that there was concern leading, not worried, kind of secondary, scared was pretty high, and never comfortable, those people that are never comfortable are consistent in the same range, about 20%. So depending on where you are, probably tells you what your portfolio looks like at this point and what you're thinking about doing. The question I'm going to ask, and I ask every time, I want to make sure we're very clear about this, what is your plan? And I'm going to take a 2-second commercial break here to mention that if you don't have a plan and you're doing this on your own, or if you don't have a plan and somehow you have a brokerage account or an advisor that doesn't have a plan for you, a very specific asset allocation model and a plan of action for either moving you into the market if you're out, or staying with a portfolio that is designed appropriately for this environment, do me a favor, reach out to us. The email is on the screen, info@horowitzco.com. Our phone number is there. You know how to get to us at the website at thedisciplinedinvestor.com as well. Now, a couple other things. What are the other things that are really driving markets right now? Well, clearly the mega caps. There's no question. The Amazons, the Googles, the Netflix to a degree, the Apples, the Microsofts, right? But what has happened recently is we saw another speculative move happen after Apple announced their split, and then followed up by Tesla. Stocks went parabolic, not at all giving up anything, with the idea that, wow, now the stock is going to be that much more affordable for the average investor who can't pay $500 or $1,000 or $2,000 per share. And therefore, if we see a split of 4-to-1 or 5-to-1, that $400 stock, which is a lot higher now after the split of Apple, is now only going to be $100 a share, making it that much more affordable. Well, that's kind of interesting, because what we do know is that splits do nothing for the stock except for bring the price down. Doesn't change the fundamentals, doesn't change the technical patterns once they are reset to the new price going back historically. So what's interesting here is that there is a lot of, you can tell the retail traders are really taking over a lot, because they're thinking that, hey, this is a good thing. That's the first part. The second thing is that there's a lot of institutions that say, you know what? The probability is that retail is really going to get excited about this. And if retail gets excited about this, we want to get ahead of the trade. So once again, we'll use the word front-running the split. We saw the same thing happen with Tesla. Now a lot of questions are being raised as, who's next? Who is next with a high price share? Are we going to see Berkshire Hathaway trade and split? Are we going to see Booking Holdings, Google, Microsoft, a little bit lower price, but still? You know, these are the questions, these high price, maybe over $300 per share, that we have to look at to see if maybe this is going to be something that is being seen by the public and then grasped onto by the companies to, quote unquote, create additional shareholder value. If in fact they could just simply just do a split low cost option and the stock is up 10, 15, 20% in a matter of weeks, why not? Even though there are partial and fractional shares available from most brokers in most circumstances, if you only want to buy, $150 worth of the shares, or in fact, if you want to go to an ETF or a mutual fund that holds a predominance of that particular shares in their portfolio, still, the thing is, somehow it made a difference. And you got to bet that a lot of companies are now looking into this option of the same thing. Now, switching gears for a second, let's talk about what we're going to see over the next few weeks. Clearly going to be political headline action extraordinaire. We saw that the DNC, the Democratic Conference, came and went virtual. Kind of cool how they did it. If any of you watched it, whether or not you like the substance of it is a different story, but kind of cool how they put it all together. Not as much excitement without a crowd, obviously, but the RNC is going to be kicking off today, and we're going to see what's going on. And President Trump was nominated for re-election officially. So that is your Republican candidate, and Biden is your Democratic candidate. So we're going to see a tremendous amount of political headlines going to be heating up. Watch for a lot of promises. We've all been through this. We know the game. There's going to be a lot of promises. We saw something already today where last night at 6 p.m., which is, of course, right before futures open on a Sunday evening, President Trump came out with the announcement that the FDA approved a new potential treatment. And this is involved in, it's kind of interesting because this was going to allow for the convalescent plasma to be used for emergency use only. And what's weird about this was that I think it was about a week ago or so, the FDA said, no, there's really no reliable evidence that this is something that really helps. And then President Trump came out with a tirade about, very deep state underpinnings in the FDA not allowing this stuff to come out. And within 48 hours, of course, we get an approval. Just days before, it was seen as ineffective, and all of a sudden we get this approval for emergency use. We're seeing the same thing with AstraZeneca now. President Trump wants their drug used for emergency use. AstraZeneca said recently, you know what, we don't think we're really ready for that. This is days ago, and just today we're seeing this. Markets are rejoicing. Hey, that's great. That's great. There is the potential for something. We've seen some of the treatments already do well. But my point here is not so much what President Trump said, but it's what President Trump is saying and what the competitor, Vice President Biden, is going to be saying, all about things that they are going to be promising and can be doing and will be doing heading into the election. Billions are going to be spent in advertising. So just keep a watch on all this and realize a lot of this is going to be market moving one way or another. And for those of you that are keeping score with the thought that, hey, you know what, if there's going to be a tax increase, because already Vice President Biden has said, hey, you know what, we're going to have a tax increase if I'm elected. And we will shut down the economy if we need to, if I'm elected. Polar opposite of what we're talking about with the current administration. Markets don't seem to care at this point, even though some polls show that Biden's ahead. And we all know about polls. So let's just put that aside for 1 second. But I'm just saying that markets could be reacting to this, but they're not. In fact, we know something else, don't we? Each and every week we talk about this. Markets are not reacting to anything right now. Markets don't seem to be too concerned about any of the real situation that's happening with the economy, with unemployment, with a trade spat with China, with the situation of a resurgence in areas like South Korea, the potential of what we saw today in, I believe it was Hong Kong, where there is some thought now that you could get reinfected if you don't have a substantial amount of the antibodies. And all this is kind of whirling around, schools being reopened and all of that. So this is all going to be in play, not necessarily bad, but all in play. Earnings season has now winded down pretty much. We're in wind down mode, but getting towards the end of it. So what's the next catalyst for the market to continue higher, except for the fact that markets seem to want to go higher no matter what? Well, I think it's going to be fiscal stimulus. So what we have seen recently is the idea that's being floated around of a skinny stimulus bill. It was originally proposed at about an additional $3 trillion was going to be put on the table by the Democrats. They approved that. That was dead on arrival in the Senate. White House says there's no way we're doing a lot of the stuff that's in here. A lot of the stuff is not related to COVID. We want to make sure to take care of the people that we need to take care of that are affected by this crisis. That's what this is all about. So we're talking about somewhere near a $500 billion price tag, which seems a lot lower than we saw before, with $7 trillion of total stimulus already pushed in, $3 trillion being proposed by the Democrats, and only $500 billion in the next stage. Is that really going to help? Let's just stop for a moment and take a breath. $500 billion is a heap of money. That is substantial, on top of pretty much the unlimited amount of money that the Fed has available to boost their quantitative easing purchases, bond buyings, and all that to keep the market healthy. So while we're seeing a bit of a slowdown right now, this $500 billion could help, because right now the $600 per week that was being pushed into the hands of people who were unemployed, it was the extra money on top of the state money for an unemployment benefits that was provided by the federal government. Looks like it's going to be anywhere from $300 to $400 per week if they can get that through. There was an executive action done, the executive order a few weeks back that said that if states contribute $100, the federal government will kick in $300 per week. That was clarified later. It says, well, the states don't really have to kick it in, and we'll give it anyway. And then the government gave money to the states. I don't think that anyone has received their $300 or $400 per week as of yet. I think it's still being worked on by the states on how to actually get this done. And what that gives us is a bit of a gap here. So I would venture to say that with last week's initial claims that are now over 1 million again, a kick up of about 200,000 people that lost or that went in for initial claims above the previous week. So from 900,000 to 1.1 million, a far cry from the heights and the heavy numbers that we saw at the peak. A far cry from that. But still, we're not on the positive side yet, of this, where we're seeing that, well, it's only, let's say, 300,000, which is kind of more normal, the numbers will be able to see a major growth and a stabilization in the unemployment rate. Right now at 10.1%, we saw some better numbers, millions of people getting their jobs back. But from what it looks like, there's a slight bias now towards leveling off, not only on the employment situation, but the economy. So that kick that we got on the reopenings or the partial reopenings at this point, and adding that to the incredible amount of pent-up demand that was out there, seems to be kind of slowing down a little bit when you look at some of the numbers. We're going to see some of the information come out this week. Tomorrow we have consumer confidence along with the Case-Shiller numbers. We have second quarter GDP, the second read on it to clarify and to get, we're still at probably negative 30-something%. And then, of course, we have at the end of the week PCE prices, initial claims, et cetera. And the following week coming up, we're going to see the next unemployment number and the unemployment rate for the month, the first Friday of the month. So we're going to see that. Okay, a couple of things, and then we're going to answer some questions. Like I mentioned, we got a lot of questions. Please ask and add your questions, and we'll get to them. Put that in the Q&A panel for this. A little dry, getting a little flavored water. All right, this is what I want to look at. We talked about this in the beginning and the top of the show, the discussion how the large caps are really holding up the markets, and where there is a concentration in the returns and a divergence in the advanced decline, where the advanced decline line is starting to come down a bit, but markets are still moving higher. Now, we looked at this a month ago or so, and the spread was not as severe as it is now. We looked at this, and what we're seeing on the screen right now is the S&P 500 equal weight, which is the blue line. Okay, that's the blue line for the equal weight. And the red line is the S&P 500. So we're looking at the index themselves as not dividend adjusted. What this is simply the equal weighted S&P, where each and every stock gets their own return divided by the number, the average return, and that's what you get. Whereas the INX is a capital, a market cap weighted index. And what that means is the larger stocks get a heavier overall component in the aggregation of the return. So what we're seeing here is, and if you really look at this, pretty much things were playing along very nice. Stocks are moving up, stocks are moving down together, even all the way through the bottom where we saw equal weighted get a little bit hit harder. We know that small caps got hit harder than large caps, but then it started to spread out on the recovery until we got into, I'll say, late May into June, where everything was kind of back, right? Things were looking better. This is since the beginning of 2020. And where it looked like there was the opportunity for, just people investing in indices, and it was going to be, the various indices, the large, small, mid, are going to be performing. And then we saw this incredible change right about there where we saw things come down, but the stocks, the smaller stocks, the mid caps, anything but the large numbers. I mean, right now, Apple and Google and Microsoft and Amazon and a couple others comprise 20% of the overall index. Now look what's happened here. Where the S&P 500 is up 5% for the year, the equal weighted is down 4.716. In other words, you probably look at a portfolio, and if you had a portfolio of S&P 500 stocks, you're not going to be looking at your portfolio on a market cap weighted basis. You're going to be, what's the average return compared to when I take in consideration how much money I have. But if you have equal installments of all the different stocks, you're going to be probably not producing the returns that the S&P did. So it's very warped this year in particular with the returns. But more important, what this shows us is that all things are not created equal when it comes to the stock market right now. The flight to safety, the names that have solid balance sheets, that have the perspective and potential to make a lot more money in the future, at least from the eyes of an investor, and more importantly, who have been doing stock buybacks, maybe increasing their dividends, and are probably in the tech or the healthcare industry have been doing a lot better. Other things are still underperforming significantly. And all we have to do is look at the small cap universe or even the mid cap universe in some areas, and then even split it between growth and value, and it's a whole nother story that's emerging. So what we see flashing on the screen of CNBC or Bloomberg or on any other channel that you're looking at the end of the day, hey, this was up or down this much, is not necessarily representative of your portfolio. It's not representative of what real people are earning on their money, unless you are an index investor and you just have it all in an index. That's first. And the last thing I want to mention, I got a mail-in question. It's actually an email. Nobody sends things by mail anymore. This came in from Ron. I thought it was a really good question. He says, what technical or fundamental indicators are used to determine when to sell a momentum stock? And my answer to him was this. I wrote back to him. My answer was kind of simple. I said, listen, first of all, a momentum stock, or a MOMO as we call it, oftentimes does not really have a lot of fundamentals that line up to where the stock is going. Take Tesla as a great example of this. Tesla is bigger than Walmart. Walmart has 10 or 15 times the sales, net earnings that they have. Now, whether or not you believe that Tesla will overtake the world one day, and maybe, I don't know, they're going to be taking over Walmart somehow and create an incredible backdrop. And if you own Tesla, that's great for you. But here's the deal. The fact of the matter is that when we look at a momentum stock, you have to really turn to the technicals moreover, and also what's happening with the markets themselves, because oftentimes about 80% of the move of a market will be representative by the move also within a momentum stock. So depending how far it's got ahead of its skis, if it has, and depending on how far it's above, let's say things like its RSI is above 80, it's 5 times or three, let's say 3 standard deviations above its 200-day, 200 2 standard deviations above its 50-day moving average. Things like that are best used for those momentums and the Momo stocks. All right. So with that, we're going to get to the questions. Man, there's a lot of people in the room today. Thank you. Thank you for coming. I really appreciate you being here on Mondays with us. All right, let's go to the first one. Steve asks, or he says, last week, I asked about investing cash in large cap companies with high yields. My search ended with 6 companies. On your advice, I eliminated 1 and invested in 5. Cash flows are either stable or future prospects are bright for the 5. Risk is controlled with position sizing. So far, so good. Thanks for addressing my question last week. Oh, well, thank you. You're very welcome, Steve. Yep, did your homework. I think that's great. Awesome. Doug, what do you make of the law firms that are filing shareholder rights litigation against small caps that are actually deliberately trying to drive the share price down in order to profit on the short side? Even if they disclose this, shouldn't this be illegal? How can a retail investor guard against this? Seems very unethical, but perhaps the word ethical and lawyer shouldn't be used in the same sentence. Doug, let's be honest about something here. What's the difference of that or sell side analysts constantly raising the price of a stock just to bounce it higher in the public? What's the difference of a company maybe filing a lawsuit on a stock and on maybe something they did find that was significant and maybe helping out the investors really locate something that's wrong, and the stock goes down and everybody makes money on it? I mean, the fact of the matter is, first of all, let's not get confused with the fact that stocks can go up and down. Let's not get confused with the fact that sometimes there is some improprieties done at companies. Now, whether or not it is something that's real or not is another story. Whether or not it's something where you have a company, when you have a company come out and say, well, this stock is at $50 and we put a price target at 75 because here's all of our reasons why we think that. Everybody's like, yeah, that's great. I love it. But when somebody comes out with, hey, you know what? We're putting this down to a sell. Stock's at 50. It should be at 22, if at best. We see that there's some potential accounting inconsistencies there. Everybody's like, oh my God, that's so terrible. Stocks can go up and down. In terms of what these lawyers are doing, I don't know the ethics behind what they're doing, and I don't know really if you could tell either. Depends on really what the mode is of trying to do this. If in fact they're just trying to drop the stock down, the good news for you is, if that is the case, if they're just going after a stock and there really is no substance to their case, and you can see through that, then you buy the stock. One day it'll be a lot higher. That's the way I see it. Another question from Doug. Do you put much stock in 13F reports as far as generating ideas? On paper, it looks like the smart money would be smart. The problem is 13Fs, yes, it's interesting. 13Fs are disclosures required by companies that are investing in stocks for the certain ownership percentages that they have to release. The problem is that those are often outdated. That's the only problem. Usually when a 13F comes out and it's from a major player that a lot of people follow, you will see a bump in the stock price for a short period of time. It all depends on what they do. They could have sold it already, or they could be ready to be selling it after the bump. So, again, it's very questionable because it takes such a long time. And it could be months, could be a month ago or a month and a half ago from when they actually had that cutoff date to put it into the 13F. Michael asks, when Tesla joins the S&P 500 index, is it true that the portfolio manager of that index does not have to buy Tesla since their index fund just have to present the 500 index, and those index funds do not own every single holding of the 500? Usually, if you have an index, if there's a mutual fund that has a manager on it, and that is an S&P 500 index, they may have some leeway there. But traditionally, if you have an ETF or a true index, a passive index fund that is an S&P 500 index, I don't see why they wouldn't be required to buy it. In fact, a lot of times you hear something like stock XYZ will be entering the S&P 500 from the mid cap, being replaced by this company from the small cap universe, from the S&P 600 or whatever it is. And usually you see that there is a significant transition in that circumstance. I don't really know of a manager that would not take the opportunity to put a stock in. There is no reason for an index fund, a true index fund, not to have a stock inside of their portfolio that may create a problem for their returns long term. And if in fact you were an S&P 500 index ETF investor and you saw and compared the portfolio holdings to the actual index and you saw a major discrepancy, I would dare say you'd probably pull your money. That's not what they're trying to accomplish. I guess it's possible, but I don't think it's probable. Next question. What is your take on a company raising capital via the special purpose acquisition company SPAC approach, which seems to be popular, versus the up and coming security token offerings? Either way is a way to get in the market. I am really not the expert on security token offerings. I know there's a whole different animal. I think there is a difference also potentially in oversight, in terms of regulatory oversight on the two. The special purpose acquisition companies are an expensive process. You have not only the equivalent of an IPO, but you also have all the costs related to the IPO as well as the manager cost on top of it. We saw that some companies are doing this, saying, hey, you know what? We can get on the market very easily through a SPAC. But remember something, they're going to get on the market, pay all the fees, pay all the IPO fees, get on the market. And then on top of it, you can have the manager who charges you on top of that. So now you have, it's the equivalent of owning Ford, but there's a manager taking 1% of your Ford value every single year. Can you imagine if a company like that, if a company that was existent already on the stock market, let's just keep on using Ford, says, you know what, we're going to, for some reason, I don't know why, we're going to get bought up and put into a SPAC. Once that happens, now you have the manager that's going to be collecting all that money on it. Could be 1%, 2%, maybe even a profit percent. So I really don't know enough, I'll be honest with you, about security token offerings to talk about that. SPACs are a little bit edgy enough right now for what's going on in the current market. And only in a market like this where there's a lot of froth and exuberance would you see SPACs doing as well as they have do. Joe asks, if you have a CD coming to maturity, should we withdraw or let them ride? You know, it's funny you asked me this question because I had this question from somebody the other day. There was a prospective client that came to me and they had a portfolio. Let's just say it was upwards of $2 million, but they had $250,000 of CDs that were maturing. And they said, here's the deal. We're kind of happy with our current money, but we'd like to possibly move it over to you. But first, we really want to focus on the CDs. And I said, well, what are you doing with the CDs? And the answer was, well, we've been relying on them for a little bit of income throughout the years. It was a nice enhancement to our current portfolio's income. The problem, though, is that if I renew my CD now, it's going to be at like sub 0.5%, maybe 1%, but probably not. And, you know, if I have to lock it up for a period of time, that doesn't give me a lot of income on that. And I said, there's your problem. The problem is that CDs right now are not returning income in the form of an income stream because of the low rates and the situation with the Fed pressing everything down to the zero bounds, right? However, what's your alternative? Your alternative is to have a non-FDI insured investment, if that's something that's important to you, guaranteed, to move into, let's just call it, you know, a bond. What bond are you going to buy? You're going to buy munis? Maybe we get you a couple of 3-4%, maybe after tax equivalent. Possibly you could look to buying corporate bonds. Maybe you get 3%, 4%, maybe 5%, depending if you go how far you go out on the risk scale. But the problem is that, are you going to be comfortable with that? Is that something that you're going to be comfortable for? What is this money for? If the money is kind of like, well, I had it for safety and, you know, it's really long-term, just kind of something I've had and I've been rolling it over, not thinking anything else, then yeah, you know what? Maybe that's better situated in a portfolio of diversified assets. If it's something that you feel very strongly about, where you're going to be concerned about, when I say losing money, we're always concerned about losing money, but we're concerned about, you know, this money losing in particular, then put it in the CD. If you realize that, one, there's safety in it, two, there's no yield. So basically the money is the money that you're going to have and it's not going to change. If in fact you want to get return on it, maybe there's another alternative. But right now, in this current environment, there's not much can be said about CDs or bank savings accounts or even money markets anywhere to begin with. So hopefully that answered that question. If it's long-term money, probably put it into a portfolio. I'm thinking that if you can understand the risk factors associated. If it is money that, it's only for safety, maybe, your real safe money and your emergency fund kind of money, then leave in the CD and understand that you're not going to be making any money with it. Good question. Next question comes from Nico. Hello. He says, how does the skinny deal, 500 billion, play with a report from JP Morgan that everything below 1 trillion will cause a market correction? Or is this rumors of, or is it fake news? JP Morgan did come out with that. Basically said under 1 trillion, really. Yeah, that's what he said. Right. Under 1 trillion would cause a market correction. Right now, the market is pleasantly, I would say, in a vegetative state, not looking at any outside information right now. Or maybe look at a different way. It's kind of on autopilot and nobody's looking at the controls at all. Right now, the markets are discounting every single thing out there. A $500 billion deal without a follow-up would be a problem. I agree. That is a far cry from the numbers that they were looking at just weeks before. You have to ask yourself, why don't the markets care? Well, the markets do care. The markets care in certain areas, but not others. The markets care, for example, when you look at the market from the aspect of, let's say, the small caps, right? So small caps were up today, but they've been kind of like, not too happy about a few things. And with all this risk on trade, you would expect that to do a lot better. The idea that there is a significant disconnect between the market, and these kinds of things has been very well documented. And I think that the reality is that there is hope that due to the fact that we're in the last part of an election cycle, running up into an election within months, that there's going to be a lot more potential promises made, and everything will be done, excuse me, in order to keep this market up. Because remember something, this current President Trump, his gauge of how well he is doing is really focused in on the economy, and particularly he looks at the stock market. And that being the case, I don't think he's going to let that happen, or at least he's going to try not to let that happen. But that is the numbers under a normal market condition. I agree with JP Morgan wholeheartedly. Next question comes in. What's your opinion on the mortgage lender stocks? I was hesitant to buy RKT last week and it took off. The interest rates are low, home builders are doing extremely well, and the vaccine hopes rise. However, many people are behind payments and the unemployment checks may stop soon. What are the factors and what data should I look at? First of all, Rocket Mortgage, Dan Gilbert's company, out of Detroit, actually. These mortgage companies that are mortgage either lenders or they are mortgage acquirers or they're mortgage intermediaries, with low rates as they are right now and not having to necessarily like a bank pay out, it could be a decent environment for them, but not great. Not great. The only thing they're doing is probably a heap of, two things. They're probably doing a lot of new home building because you mentioned that the home building is very strong, but they're also doing a lot of refinance. And the refinance for them is probably making them money. Now, whether they could just sell that off very easily to somebody else once it's refinanced, they're probably getting points on the whole deal, and that's probably a good thing for them. Do I think that's something that I would want to own long-term? In this environment, no. The problem is going to come in if interest rates go up and if they're not selling off their mortgages, those mortgages are not going to be worth as much in the future. So that stream of payments aren't going to be as good. And if in fact they don't have any money, well, okay, that's going to be a problem. But don't forget, right now we have the Fed buying everything. So if things fall apart, they'll probably get a bailout also. So like a friend of mine once said, one day when I come back, I want to be reincarnated. I said, well, what do you want to be? He said, a bank. Banks don't fail. Generally speaking, they have lifelines from everybody. The politicians love them, the investors love them, and the Fed loves them. The Fed is set up to help the banks. So, yeah, it took off. It dropped down after its IPO. It IPO'd like a week and a half ago, dropped down significantly below the IPO price. I believe it was below the IPO price, and then just took off like a rocket. But that's the kind of environment we're in right now. The fact that it dropped so significantly right on the IPO does concern me, though, for that stock. We have two more questions. John asked, retail investors, for years they have been mocked and discounted as a very small portion and have very little effect on the market and market swings. Suddenly, in 2020, with the emergence of Robinhood, all the analysts are giving the retail investors credit for huge swings in the market. Obviously, they have increased over the years, but no way can they touch the big players. I don't buy it. Do you? Nope. I think they're a part of it. And I think on the edges for some of the more speculative things, like what we saw what happened with Kodak, for example, retail was in there. And you can see that with the Robinhood data. You know, the professionals are not going to be buying, but on thin stocks that are moving very quickly, you can see this happening dramatically. Some of the IPOs that they want to get involved in, some of the name brands that they want to get involved in. But I agree that generally speaking, when we look at the retail investor, especially who are trading with $3,000, $4,000, $5,000 accounts, they're not making a major, even if you add up, you know, a bunch of them, they're not really adding up to this. However, remember something. Analysts on the sell side are never wrong. They're just either too early or too late or about to catch up. Stocks move against them, they change it. They change their opinion, and everybody forgets about what they said, you know, before. Everybody that they bring on CNBC seems to be the number one picker of any stock. So remember that, you know, if you don't really see their portfolio, when they bought it and what they have and what their analysis is, there's a big game being played by that side. I don't buy it. I agree with you. I think on the edges, though, it is true. I think with the smaller stocks and the very limited volume. Last question comes in, and well, maybe there's one more. How can individual investors see the smart money flowing in and out of a stock or ETF? I don't think you could really see smart money. I mean, well, let me say this. Some of the indicators that we created will give us a real nice footprint in the sand of where trading is happening. We come, so when my analysis, when I'm looking at a stock, for example, or ETF a little bit less, because you can look at flows, but ETF flows go in and out, and it's really the price. The answer to your question is price, by the way, price and volume. When I like to look at this, I like to combine the whole idea of price and volume, count every single trade and what volume was and what price was for that trade, and then put it on a chart. It's not easy to do. It's something called market profile. You can look it up. You can go over, actually, if you want to see this in action, go over to triggercharts.com, and there's a video section there. You can see a lot of it going on. I narrate a lot of that. It talks about these areas in the market where you can actually see very clearly high volume buying of a stock at certain prices. And when you see that, you can kind of get a footprint of where the big traders are trading. That's kind of important. It's very, it makes it almost transparent. So it's all about volume. And when you see, you could do things like time and sales. Time and sales, if you see a lot of ticks going off at 100 shares and then a couple of 10,000 shares, well, you know, there's a big trader in there. However, there's also algorithms. I could do that with ours. We do that where you say just leak out, you know, 100 shares at a time at these prices. I don't want to pay any more than this. So it looks like there's, you know, not a lot of trading going on. So you don't get the market going the other side or with you and bidding it up. Last, I guess, is a comment from Kurt. It says, thanks for doing these weekly calls, Andrew. I greatly appreciate them. I might not always agree. Well, I don't agree either all the time, but I learn a lot. Thanks so much. We'll be back again next week. Before you go, DH Unplugged on Tuesday evenings. We'll be there talking with you, analyzing the news, all the things that are very interesting and some that are a little bit funny. We do some limericks. We do some games with the listeners. You can win some things. We have some giveaways. dhunplugged.com. And of course, this week's Disciplined Investor coming up next week and as well this week. So go over to Apple, iTunes, or anywhere else you can find your podcast. Thank you so much for joining me, and I'll see you again next Monday.